Nvidia is now the most valuable public company in the world, and in fact this is a company that is up 9 times since just the end of 2022, and not only has it passed the 3 trillion market cap in early June, but it is now more valuable than both Microsoft and Apple, with the majority of this essentially coming down to the artificial intelligence which they have really been able to capitalize on. Now this is also a company that just in the last week it is up over 5% even after the stock split, and if you've been a shareholder over the last 12 months, well, you would be up 207%. In fact, we can see here that Wall Street still indicate Nvidia as a very strong buy. Now this is a company that when we do take a look at it over the last 4 quarters, they have beaten analyst estimates, 100% track record, and in fact look at that, in the next quarter they are anticipating triple digit 135% year-on-year increase to the earnings per share, and even to the subsequent 3 quarters they are still seeing some very strong growth on that EPS. And on top of that, when you take a look at their earnings per share estimate for January 2026, if they are able to capitalize on that, their forward P does come down substantially to around 38.08. Now there are a lot of positives with this company, none other than the fact the earnings per share that we discussed, but over the next 5 years as well, they do believe that this will continue to grow 32% year on year for the 3 to 5 year period, and that isn't surprising when you just look over the last year. They were able to increase their top line by 208%. In fact, over the next year, they still see massive growth, 80% being baked in. Now that doesn't stop. This has one of the best net income margins that we've seen in any company we've reviewed on this channel, 53.4%, which is very strong, hence why they do get an A+. So this is definitely one that you should seriously consider in the portfolio. And in terms of their competitors, if you wanted to see others in the industry, well, historically Nvidia has blown them all apart, up 31,000%. Do bear in mind though, past performance is an indicator of future, but we can see even Broadcom, which has performed very strongly, as well as AMD, don't come anywhere close at all. Now, no surprises when we do take a look at some of their metrics. The return on invested capital is very strong. In fact, 61% in 2024. On a trailing 12-month basis, this is expected to continue 78%. So a phenomenal metric, makes it incredibly attractive to investors who are considering purchasing. And what this shows us here, one of the metrics we love to use on this channel, the net debt to EBITDA, 0 across the board. Now for semiconductors, we want to see below 1.5. This indicates to us their balance sheet is incredibly strong. It won't even take them 1 day to pay off all of their debt net of cash on hand, as that is what this figure shows. So pretty much a bulletproof balance sheet, and the metrics don't stop there. Typically on this channel, 3 to 7% growth is what we want to see. Well, for Nvidia, just look at that last year, triple digit growth, trailing 12-month basis, 208%. And if this continues, this could be one of the fastest growing companies in the S&P 500, although you could argue right now it does sit at that title when you do see it is the largest market cap, currently just toppled Microsoft. Finally, the other metric we do want to point out, free cash flow per share has been phenomenal. The increase just over the last year from 15 cents per share to $1.09, but as we can see over the next 12 months, they are anticipating this to continue 2.59. Finally, the last thing that we do want to point out before jumping into the valuation is the growth we have seen on the revenue. FY23 more than doubled into FY24, and the party does not stop there. Quarter 1, 26 billion. If we extrapolate that for the full year 2025, that is essentially 100 billion in terms of revenue in 2025. And not only do we like to see an increase in revenue, but these numbers, percentages you see here are essentially the operating margin. It has gone up from 34% in FY20 to essentially 61% in FY24, indicating to us a lot of operational efficiency. Now, before we do jump into the valuation, just to let you know, we've released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment below. Lots of very interesting articles, even showing 12 undervalued stocks for your attention. So let's jump into the valuation model of Nvidia, getting to our price target. And don't forget, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through 4 models: Graham's, multiples, DCF, and DDM. Now, we'll explain to you why we're not going to use the majority of these today. First one, Graham's valuation. We only use it for more mature companies, but if you're interested in seeing, we've put the numbers in, the earnings per share, the growth rate, the AAA corporate bond. This would give essentially an intrinsic value of $95 with an overvaluation signal. Again, the multiples, we have companies in a similar sector and size. We have their average P multiplied by Nvidia, but again, we do believe that Nvidia does warrant a massive forward PE given the growth that has been expected and that they have performed. Otherwise, if we were to use this model, as we can clearly see, overvaluation, fairly obvious to see why we don't use the DDM. The average growth rate around 1%, and this dividend from this company isn't the main reason why people are looking to execute on this company moving forward. So the main one we're using is the DCF model. Now we do have the free cash flow year on year. Average growth rate sits at 94%. That is phenomenal increase, and we are looking at a low, medium, and high rate moving forwards. We've gone for 25% to start off with the low rate. Now with the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we do get an intrinsic value showing overvaluation. So if you do believe over the foreseeable future it will grow by around 25%, then that would be implied downside of negative 26%. What we would point out here is when looking at the expected growth just into the next year, this is more than 100%. So you can see that maybe a lot of people would argue that it is being too conservative. That takes us onto the medium growth rate of around 30% moving forward. And as we can see, an intrinsic value of $140. We do have an undervaluation signal, but we can see the upside is 3%, so very marginal. You could in fact argue essentially reasonable valuation. Now people will say that is still too conservative. At 35%, what we can see here then is a price of $192 with essentially upside of 42%. Now these numbers are subjective depending on where you see this company moving forwards over the next 10 years in terms of AI, but as always we can see the market itself is expected to grow massively, with a report from Bloomberg stating that the generative AI is accepted to exceed around 1.3 trillion market by 2032, which is essentially a compounded annual growth rate of 42% over the next 10 years. So essentially this isn't a bubble according to their research, and therefore we should expect continued high growth from Nvidia moving forward. Now for our final analysis, we do want to be conservative, so we will start with 30%. When we get to our intrinsic value, then no surprises here. It is essentially just the DCF model of $140. And with the current price not too far off, you could argue reasonable valuation. What we typically like to do on the channel is have a 10% margin of safety, which we execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Nvidia, we'll buy up to $126. At 5%, you can see it isn't too far off, but not even at a 5% margin of safety. So right now, we do see it trading towards its essential intrinsic value. For those that want to see even more of a margin of safety, well, 15% would be 119, 20% would be 112. But as we said, no margin of safety. We do see this price essentially around $140 over the next few months heading into the end of the year, so very minimal upside. In terms of Wall Street, well, they see essentially upside of negative 3%. They do see it trading around $131 over the next 12 months. So again, do let us know your thoughts in the comments below, whether or not you agree with this price heading towards the end of 2024, whether you see this growth continuing. In fact, it is just up, as we mentioned, 5% over the last 5 days. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next